Are you paying more tax than you legally need to? It's a simple question, right? But the answer, well, that's a whole lot more complex than you might think. It's like trying to find your way through a maze of rules, regulations, and frankly, a few hidden shortcuts.
So let's just cut to the chase and ask the big question. Can you actually, legally, pay less tax in the UK? The short answer is yes. But the real question is how, and even more importantly, where's the line between being smart with your money and stepping into a very, very risky gray area?
Now, to help us get our heads around this, we've got some serious expertise on our side. This entire guide has been put together by the tax experts at My Tax Accountant, a top firm here in the UK. So, you can be sure we're getting a proper, professional look at how this all works.
Okay, so here's our game plan. First, we're going to tackle what I call the Great Tax Divide. Then, we'll get into how the system's own design can be used. After that, we'll see how HMRC fights back with its anti-abuse toolkit. We'll even look at a real-world case to see these rules in action. And finally, we'll wrap up with how you can navigate this whole maze safely.
Right. First things first, the Great Tax Divide. Look, you've got to understand these basic definitions. It's the absolute foundation for everything else we're about to talk about. Get this wrong, and you're already lost.
And here's where it gets really clear. Think of it like a triangle. On one corner, you've got tax planning. This is perfectly legal, sensible stuff, like using an ISA or a pension. The government actually wants you to do this. On the opposite corner, you've got tax evasion. This is flat out illegal. We're talking hiding income, lying to HMRC, and it comes with criminal charges. But then there's that tricky third corner, tax avoidance. Technically, it's legal. It uses the letter of the law, but it bends the rules in ways they were never meant to be bent. And this is the battleground. This is where HMRC focuses its firepower.
And just to give you an idea of the scale we're talking about, HMRC reckons that tax avoidance costs the UK a massive £1.5 billion a year. Now, evasion costs more, but HMRC goes after avoidance so hard because it undermines the fairness of the whole system for everyone else who's playing by the rules.
Okay, so let's dig into how this really works. We're not talking about tiny, obscure loopholes here. We're about to look at the single biggest structural incentive that's baked right into the UK tax system. This right here, this explains everything. It's the huge difference between how we tax work and how we tax wealth. So you've got a top-earning executive on a salary. They can end up paying almost half their income, up to 49% in tax. But a business owner in that same top bracket, if they structure their income as capital gains, might only pay around 27%. That is a gigantic gap, and it creates a massive incentive for business owners to pay themselves in capital, not salary.
But hold on, it gets even crazier. The tax rate on capital gains that are passed on when someone dies, it's zero. Yep, 0%. When assets are inherited, their value is rebased, wiping out all the historic growth for tax purposes. This means that generations of wealth can be passed down completely tax-free. It's a huge incentive to hold on to assets for the long term.
Let's make this real. Here's a pro tip. Picture a freelance app developer in London. Her business is doing great. Instead of taking a massive salary each year and getting taxed at that high 49% rate, she takes a smaller salary and reinvests the rest back into her company. Years later, when she sells the business, all that built-up value is taxed as a capital gain at that much, much lower rate. It's a completely legitimate, powerful strategy.
But, and this is a big but, you've got to remember the ground is always shifting under your feet. A perfect example is the non-dom status. For over 200 years, it was a major tax break for wealthy foreigners in the UK. But from April 2025, it's being scrapped. It just goes to show what works today might be history tomorrow.
That's not all. Here's where most people go wrong. They underestimate just how seriously HMRC takes this stuff. This is a high-stakes cat-and-mouse game, and believe me, HMRC has built an impressive toolkit to win.
HMRC basically has a three-pronged attack. First, disclose. They have a system called DOTIS that forces the people who create these schemes to tell HMRC about them right from the start. Second, assess. This is their big gun, the General Anti-Abuse Rule, or GAR. It gives them the power to just shut down anything they think is abusive, even if it technically follows the law. And third, enforce. This is where accelerated payment notices come in, and they completely change the financial risk for the user.
And here it is, straight from the horse's mouth. The GAAR isn't for targeting your everyday pension contribution. It's specifically designed to go after abusive tax avoidance arrangements. Those weird, contrived schemes that have no real business purpose other than to get a tax break that was never intended.
Now stay with me because this next point is absolutely crucial for any business owner. The GAR is a priority rule. You know what that means? It means it can basically override almost any other tax law on the books. So even if a scheme seems to take every single box, if HMRC decides it's abusive, the GAR can just wipe out the tax benefit. It is their ultimate trump card.
And this number is what makes HMRC's enforcement so powerful. 90 days. It used to be that if you used a tax scheme, you could keep the money you saved for years while the lawyers argued. Not anymore. Now, if HMRC hits you with an accelerated payment notice, you have just 90 days to pay the disputed tax up front. The cash flow advantage is gone, and all the financial risk is dumped right back on you.
Okay, so it's one thing to have all these powerful rules, but it's another thing to actually use them and win. Let's look at a real-world example to see just how determined HMRC is.
But before we get into the specifics of the case, you need to understand this simple fact. HMRC wins. The data is crystal clear. They win the overwhelming majority of tax avoidance cases that end up in court. So thinking you can take them on and win is it's a very risky bet.
The case we're looking at is Blackfriars Hotel versus HMRC, which was decided in late 2024. So this isn't some old, dusty case file. This is a recent, relevant example of HMRC taking apart a very complicated scheme set up by a big company.
So what actually happened? Well, to put it simply, the company created this really complex setup to use old financial losses to wipe out their new profits. HMRC took one look and said, nope, this is totally artificial. It only exists to avoid tax. And you know what? The court agreed with them. It was a clear-cut win for HMRC, and the company was stopped in its tracks. It sends a very loud message.
So the crucial point is, the world of tax is a minefield. The rules are complex, they're enforced with real teeth, and getting it wrong can cost you a fortune. Not just in money, but in sleepless nights too.
So let's boil it all down. 4 key takeaways. 1. The line between smart planning and risky avoidance is incredibly fine, but you absolutely have to know where it is. 2. HMRC is not a sleeping giant. It's wide awake and has a powerful toolkit. 3. The rules are always changing. Loopholes get closed. And that brings us to the most important point of all. 4. Getting expert advice isn't a luxury anymore. It's a flat-out necessity.
Now, of course, we have to include this quick disclaimer. Everything we've talked about today is for general information. It's here to give you a better understanding, but please do not rely on it alone to make your financial decisions. Every person's situation, every business is unique. That's why you absolutely must talk to a qualified professional. Seriously, don't try to navigate this tax maze by yourself. The only way to be sure you're doing things right and efficiently is to get expert, compliant advice.
And for that expert guidance, the team at My Tax Accountant is who you want to talk to. Whether it's about what we've covered today or any other tax questions you have, they've got the professional expertise you need for both planning and compliance. You can give them a call on 0208 570 8531 or just drop them an email at info@mytaxaccountant.co.uk.